We are continuing our breaking news coverage of the Bank of Canada rate decision, maintaining rates at 5%, the highest level we've seen in this country since 2001, lamenting about the fact that getting inflation back down to target, progress has been slow, threatening the possibility of another rate hike to bring it under control. And yet, the market reaction is kind of dovish, though we can't operate as though we're in an island. The Canadian dollar is selling off, but we're seeing a broad rally in the U.S. dollar. We are seeing the Canadian bond market sell off, but there too, we are seeing a global sell-off in the bond market. And one of the most rate-sensitive parts of the market, of course, is housing. And for a long time, people have been able to hang on because of the various different ways that banks gave mortgage owners a leeway to deal with the rising rate environment. That starts to expire in a couple years' time. Let's get some perspective. We still have Jim Thorne on the desk of Wellington-Altus, Earl Davis from BMO, but now Barry Fenton joining us, the CEO of Lanterra Developments. And these guys can think about stuff, but you have to actually put your dollars to work and decide, is it worth for me to build, given the economy, given the interest rates, given the cost structure? We've had this extraordinary move in rates, but we've also had policy interventions, and I haven't spoken to you since then, to stoke development, to deal with housing shortages. How do things feel for you right now?
Well, there's no question we're looking through the windshield with some snowflakes. I mean, it hasn't been a perfect run the last 4 or 5 months. But I think, again, I've watched our esteemed guests talk about, and you guys did a good bout between you, but the truth of it is that the market is still good. We're healthy. Our asset class is, in my view, untouchable. And there's no question that people are concerned now about interest rates and where they are and how to finance and take care of their debt obligations.
Why do you say it's untouchable? I mean, there's major headwinds, right? Not least of which is the cost of financing these projects.
Well, from a costing standpoint, I think we have redusted off all of our pro formas, and anything that was now starting has completely different parameters to it. So we now know what we have to charge and how we can get to the end run. There's no question that on some of the developments that people came out and built over the last 3, 4 years and 5 years, they're not making the profits that they should have. The one thing that we need on our side, which we do have, is we have fantastic banks that understand our portfolios and they're supportive of us.
So you're still getting the financing, you're still getting access to financing.
Not an issue, but no one wants to pay prime plus a half, make that an 8% number to carry. There's no question about it.
The interventions that have been announced at the federal level, the provincial level, to encourage folks like you to develop more, scrapping things like the HST tax, what did that do for your models?
I look at the supply-demand component, and there's still demand even in this environment, and the supply issue is going to even tighten up more. Mm-hmm. So there's no question that the government is helping out. For example, when you're building apartment buildings now, they've deducted the HST or GST component off that calculation, so it makes it more economical to build. But overall, I think we just have to get the interest rates where we are. We have to have confidence that they are going to come down. My own prediction is that a year from now, I think we're going to be down 2% from where we are. It's just my gut. I think when they hit it, they're going to hit it hard, and they're going to come down fast and really fast. You guys may not agree, but that's where I'm at.
I like him. He's talking my book.
Well, I don't know if I like all you guys, and you're from Bank of Montreal, so you're a good guy.
Yeah, I think I'm from Montreal as well, too. But I think Barry hits 2 excellent points. One is, when you get this rapid interest rate increase, the hardest part is the adjustment. Once you stabilize at a level, you could do your new pro formas. You get a sense. This goes for both consumers and businessmen. So you need that stability. It's the adjustment part that's hard to deal with. The second point is, as I said for many times, people don't buy houses or condos. Banks buy houses or condos because they have the title, people have the mortgage. Yeah. And as long as banks have good numbers coming out, and they do because they have well-diversified businesses. It's not just all real estate. It's not all trading. It's not all commercial. It's well-diversified balance sheet, which is why we like the banks. They will still continue to lend. And those are 2 key important points that I think Barry hit upon.
Let me just tell you a quick secret here, because I bet you most people don't know the secret ingredients of how we work. But in today's environment, what I'm seeing now is that the high-end really good development community. We're all kind of aligning and getting together. And when someone comes in to buy a condo, we know that rates may be higher than we wanted for the end user. So we're providing an incentive on some of the projects where we discount the mortgage rate, the component of what it's going to cost. So at the end of the day, we have certain giveaways that we have to deal with and incentives. And that's how we think it makes sense to deal with now. Because at the end of the day, you need a purchaser. You need a bank to give you the money to do the construction. You need takeout financing. And if we can provide the extra incentive where the cost to run that mortgage is covered by us, however we come up with that calculation, that's a good formula.
So you are having to do things.
Oh, no question.
Like, even though you're saying demand is structurally there, you are having to do things to, excuse me, entice people.
Well, I've been around for a while, and I've always had to be creative. And you have to go with what the moment is for the day.
U.S. banks, U.S. housing, publicly traded housing companies have been buying down to get people in for the cycle, and they've gotten to the point where their margin degradation is to the point where they can't go any further. So you listen to a call like D.H. Horton, right, or KB Homes, they're there. They're at that breaking point, right? So yeah, we don't have the supply here. But I just sit there and say the banks are okay now, but they haven't started to basically refinance all those mortgages that were basically issued a few years back.
Well, let's talk about that. That
rates.
seems to be the accident that could be waiting in a few years. All those people in 24, 25 that have to refinance, possibly at materially higher rates, though if we get rate cuts, maybe it'll all kind of work out. But how do you think about the magnitude of that risk, and is it something that you position for today?
Yeah, I disagree. I avoid banks. I just think the Canadian bank, as I've said, and I know this is repeated, and I get everybody uncomfortable up here. I lived through the financial crisis in the United States. We missed it up here. You don't understand what the pain is going to be like when the dry twig snaps. You're not going to be able to put the genie back in the bottle.
I'm sorry, I disagree.
Okay, go. Tell us why.
I'll tell you why I disagree. Because the reason I'm successful, or relatively successful, and where I am today, is because I looked at opportunities when the market was crappy. So if you're telling me that in 2008, it was, the world's coming to an end, people that invested in 2008 are way wealthier today in their portfolio.
Yeah.
No, but
even
listen,
at the top.
but
this is what I get. This is typical Kent. Look, so let's forget about 2008. Let's use when John Crow, Tiff Macklin's doing John Crow in the late 1980s, raising rates to fight the real estate inflation in the Southern Ontario market. John Crow was on the record basically saying, to understand inflation, you have to hammer real estate. Prices in Rosedale went down 45%.
I think you need to take a chill pill, to be honest, because I'll tell you why. Like, we can't watch the TV 24/7, 365, okay? You have to have an understanding of what markets are, and I'm not a capital markets guy that understands bonds. I mean, I know what's going on with bonds, and in fact, I'm buying 30-year bonds now for my own portfolio because I think it makes a lot of sense. But I know that the real estate asset class, guess what? Believe it or not, people want to own housing. People will figure it out. And right now, what's going to happen, in my opinion, with the banks is that right now they're overcompensating in their balance sheets because they're concerned about people defaulting. But what they're doing is in order to shore up their banking, they're going out and they're offering GICs at 5% and 6% to individuals. So people are actually more liquid than you think. As soon as this market turns around, look out. I mean, we're going to be on fire.
We see it as a low magnitude risk because of what Barry said, the supply-demand dynamic. Yes, if people can't afford to renew, they're not getting foreclosed because there's still so much demand for houses, they're selling it and most likely making a profit still, have to find alternative because there's a replacement buyer. So that's very important. Talking about the buying when things get scary, that's why we're going to be buying this quarter. We think it's going to get scary, but we're going to be buying into it because we see the opportunity there.
2 years from now, maybe even less, I think you're going to see 20 to 25% increases across the board in the real estate.
So you got bank, home builder,
yeah,
if it blows up, don't call me. call them.
Okay.
I don't think we're going to call you, by the way. Our phones are disconnected. I don't think so.
No, but the housing market here is different in a lot of ways. There's the federal government backing for a lot of it. There's an immigration picture that is very different than in the United States, and there's jobs. And that part might change, but ultimately, isn't that the indicator? Canadians culturally don't walk away from their homes the way that they did in the United States. I mean, and if you think, and you said that there's going to be some sort of relief rally in the bond market, I mean, there's just, I don't see the recipe for what you're talking about.
First off, I'm not here to be personally slandered.
No, I don't think that's what we're doing.
And I think it's unprofessional.
That's not what we're doing. Let's talk about the
secondly,
BNN,
secondly, as a portfolio manager and a strategist, I'm trying to control risk. Okay? That's all I'm trying to do, right? That's all I'm trying to do. So I'm trying to be sitting there saying, you've got the Bank of Canada. You just say 5 minutes ago, the Bank of Canada is going to raise rates and we're going to continue to raise rates, but everything's going to be fine. And what I'm trying to say, in a credit crunch, in a highly leveraged economy, in the most expensive real estate market in the G7, if not the world, people think that bad things aren't going to happen. And all I'm trying to say, as a portfolio manager, as a fiduciary, is maybe the risks are a lot higher than consensus
in
states.
housing.
In 22,000 units that Lanterra has delivered to the community, we've had 3 defaults.